Students, today we learn about working capital management, and I will tell you about the meaning, definition of working capital, concepts, types of working capital, advantages of working capital, and format for calculating working capital. Working capital is also one of the most important part of the financial management. Sound working capital management is a requisite for the firm's survival. So even though they're having a different kinds of funds in the organization, but still they will have a working capital in order to meet day-to-day expenses of the business. Now, what is working capital? So working capital is the amount of fund required for meeting day-to-day expenses of the business. It is a short-term funds. Short-term funds is say for the duration of the 6 months and maximum 1 year. So in simple words, so working capital is required for financing short term or a current assets. So current assets is or those assets that can be converted into cash within a month or maximum 1 year. So the current assets that can be include or cash. So cash for urgent payment, bank balances. So all the firm will maintain a bank balances as a current account in the bank, stock and inventories, which includes raw materials and work in progress, finished goods, outstanding trade debtors, and book debts. So outstanding means that they should not more than 1 year. Next, prepaid expenses, advances to suppliers. And this working capital is also known as a short term capital or circulating or revolving capital. Definition of working capital. According to J.M. Mill, the sum of current assets is the working capital of the business. Zubin, working capital is the amount of funds necessary to cover the cost of operating the enterprises. Western and Birham, working capital refers to the firm's investment in short term assets, cash, short term securities, accounts receivables, and inventories. ICAI, working capital means the funds available for day to day operation of an enterprises. So the various authors gave definition for working capital. So the simple definition is working capital means current. Next, concepts of working capital. So we have two concepts. First one is gross and second one is net concept. So first, gross concept. So where I have highlighted the word current assets, which means that they will be given importance to the current assets only in the gross concept. So that's what they're saying. It is a general concept which determines the working capital concept. Thus, the gross working capital is the capital invested in the total current assets of the business firm. So it is also known as current capital or circulating capital. The second one is net concept. So it is a specific concept which consider both current assets and current liabilities of the concern. So that is net working capital is equal to current assets minus current liability. So the net working capital is the excess of current assets over the current liability of the concern during a particular period. So for example, if the current assets exceeds the current liability, it is said to be a positive working capital. If current liabilities exceeds current assets, then the net working capital becomes a negative. So all the organization should have a positive working capital. So permanent working capital, it is also known as a fixed working capital. So it is a minimum level of capital invested in the current assets that the business concern must maintain at all the times in order to carry on the business activities effectively. So the level of permanent capital depends upon the nature and the size of the business. So it is subdivided into regular and the reserve margin. A regular is the minimum amount of fund they will be having for the circulation, that is to pay all the bills, to maintain an adequate supply of raw materials for processing and for the prompt delivery of the goods and services, and for to carry out the necessary accounts receivable for all the types of business engaged in. Second one is temporary working capital. It is also known as variable or fluctuating working capital. So it is the amount of capital which is required to meet seasonal demands and some special purposes. So there is a close relationship between temporary working capital and the level of production and sales. Seasonal demands is during the peak season or whenever there is a demand in the product, in that time the additional amount of current assets will be utilized. And then some special purposes is if they want to have a marketing strategy, or the way of a new way of a production policy, or if they want to experiment with the product, or they want to launch a new product, so in that situation they will be utilizing the temporary working capital. So here are some advantages of adequate working capital. So every firm is supposed to have adequate working capital. Whereas inadequate working capital means that the firm does not have a sufficient working capital to meet daily business activities. It may result in stoppage of production or the reduction in the productivity. So the inadequate working capital is very dangerous to the firms. Always they should check on a adequate working capital. So here there are some advantages. Cash discount is the business can avail the advantages of cash discount by paying the cash while the purchase of the raw materials. And the next one is continuous supply of raw materials. So if the firm is having an adequate working capital, there will be a regular supply of raw materials without any delay. And increase in productivity if the management maintain proper current assets and the fixed assets. So there will be an increase in overall productivity. An attractive dividend also will be given to the shareholder if they are having an adequate working capital. And the last one is sense of security and confidence. So the adequate working capital not only creates the sense and security and confidence among the business executives, but also to the customers, creditors, and to the business associates. This is the format for calculating the working capital requirements. Here we have to apply the net concept method. So net working capital is equal to current assets minus current liability. So whereas current assets, these are all the item, stock, raw materials, work in progress, debtors, cash balance, and finished goods. So current liability, trade creditors, outstanding wages, outstanding overheads, then you will get current working capital. So in the problem, if they have given any contingency like percentage in like 10 or 20 percentage, then that also we have to add. Then the answer will be working capital requirements. Thank you.